It's Scott Garlis at Stansberry Research. I'm here at the 2019 Alliance Conference in Las Vegas. I'm here with Enrique Abeda, editor of Empire Elite. Enrique, thanks for being here.
Yeah, thanks, Scott.
Appreciate it. So a couple of questions for you. First, how invaluable was your experience as an investment banker to your career?
Well, as I mentioned to you before, I was only an investment banker for a very short period of time in my career in the early 1990s. It was actually interesting. I was a technology, media, telecom banker, or TMT banker at Lehman Brothers during a period when internet deals couldn't get done. So not a lot of people remember this, but everyone said the internet will never make money. So it was actually a challenging period to be an internet banker. But I think that experience really helped me as I became an investor and to identify those ideas. And then it transformed itself. As you know, I also have started a digital media company. And the ability to run that company and actually have that operating experience, I think has made me a much better investor. I think that a lot of investors, almost all of them, have never actually run a business in the real world. And when you run a business in the real world, you learn a lot of things about what actually makes businesses work. And so the combination of me having that banking experience plus running these businesses has made me identify businesses better. There's a lot of ideas that I have that I look at and I say, Live Nation was one that I talked about on Monday. I know that business. I work with that business. I have a firsthand experience with it, and again, I think it's made me a much better investor, able to identify companies that are really going to outperform.
100%. And then you discuss super unicorns, and for anybody listening, these are pre-IPO companies that have raised $1 billion or more in the private markets. Does the size of these raises scare you?
It doesn't scare me from the standpoint of the overall health of the markets or the economy, because as I mentioned in my presentation, I was around for 1999, and in 1999, you saw the New York real estate market, you saw the employment market were really being affected by these companies. And I think there's an aspect of that right now, but relative to the overall size of the economy, I don't think they're that large. Actually, if you take a chart of quarterly GDP, and I'm working on putting this together, you see the spike in late 99, early 2000, GDP spiked to over 5%, I think, for a period of time. That's the only time we've been over 5% year-over-year GDP growth in the last 30 years. That meant that when that unwound, it had a very profound impact on the economy. I actually think that the unicorns and the super unicorns right now are having a dulling effect on the economy, which is they are bringing economic growth down because they're basically subsidizing investor money to private companies or to the users of these products. And again, my digital media company, we're a WeWork's customer, and I joke with my guys. I'm like, we'll never get this deal again in terms of the rent that we're paying and the deal we have. So, does it concern me? Yes, it concerns me from the standpoint of if you're an individual investor and you're thinking about investing in these great companies, just don't invest in IPOs across the board. But from an economic standpoint, I think it's a very natural, healthy thing that we have these little mini bubbles, and that they sort of get they get run out in the economy.
So you see the cycle working like it should right now?
Yeah. I'm an optimist on America and capitalism. Apologies, but I think the system is working how it should, and some of these companies. It's interesting. Amazon is the only company that ever really had that. Let's lose $1 billion and prove we can make money eventually. I can't point to another one that did. There might be one. Maybe it's WeWorks, maybe it's Uber, maybe it's Lyft. But I think more likely they're all going to zero, and we should enjoy the products while we can. But I think for the economy overall, I don't think it'll have a major effect.
Thank God for Amazon Web Services, right?
Yeah, well, yeah, it's Amazon, obviously a great company.
Yes. And then is this a sign of a private equity bubble?
It's interesting. I started my career as a TMT banker in the private equity side. And like I said, I was doing internet deals when they literally couldn't get done. Like I remember we had, CBS Sportsline was a deal, and the company was losing $30-40 million, and we couldn't get it funded at all. Eventually CBS came in. I think it is a private equity bubble a bit, but this is going to sound strange. It's kind of the people that are going to lose the money kind of deserve to lose the money because of their hubris. Like, unlike 1999, the Globe.com really hurt individual investors. Now what's happened, and again, for people that don't remember the Globe.com, it was just a random website. I think the stock went public at 9 and traded to 90 the first day. The people that lost that $81 were private investors, individuals, like a lot of the Stansberry customers. Today, it's not. It's SoftBank. It's Masayoshi Son. So there's a little comeuppance here. So I do think there's a private equity bubble. I think these people have lived in a bubble. And, I'm a Mexican or Uruguayan kid from Phoenix, but who's been able to live in this Wall Street world for a long time. I think they're going to lose a lot of money, and it's probably a good thing. To be honest.
Again, the cycle is working.
Yeah, exactly.
Yeah. I remember Netscape in particular when they went public and similar.
So the day Netscape went public was actually my first day on Wall Street.
No kidding.
Yep.
That thing was crazy.
Yeah.
So then would you say investors are better off completely ignoring IPOs?
Ignore them. One of the things we talk about in Empire Elite is the fact is, as an investor, away from trading strategies, which we have a trading strategy that we're very confident with, from an investing standpoint, you need 10 stocks. 10 stocks get you the diversification that you need. You get rid of the non-systematic risk. And so, I'm about being very, very selective. If I told you just need 10 stocks, there are 7,000 liquid securities in the United States. You add the international markets, that's probably 30,000 liquid securities. You need 10. So, like, when you're thinking about an idea, I have a weird thing where I hate the word but. Like, people will say, well, the stock's down a lot, but, or, this company's growing a lot, but. I'm an and person. Like, let's go for the best ideas. Just avoid IPOs. Like, the most important thing, again, I'm 47 years old. It's not like I'm, 67 or something like that. But simplifying my life as an investor has made me a much, much better investor. And just saying, don't do IPOs. Like, you'll be better, unless you want to short these, especially the direct listings, which is an opportunity. I just, keep it simple.
You brought that up, and I haven't heard that since like high school. KISS.
KISS, yes. Yeah. Well, I work in rock and roll, so, I'm not a huge KISS fan, but like it.
And then, so if people were not to ignore IPOs for some reason, is there a market you'd look to maybe get in safely, or just?
Gosh. Again, I believe you should just have some hard and fast rules and be very selective and don't make exceptions. What I do think is, well, I'll tell you this. I've made a ton of money short IPOs, because what happens is people have not done the research, and if you're willing and able to do the independent research, you can identify a lot of interesting situations. But like I said, just keep it simple. Don't make exceptions. You need 10 stocks. 10 stocks, you can make all your money. And there's no reason to, when you convince yourself that this time is different, you're setting yourself up to certainly not outperform and probably to lose money.
Completely agreed. And then lastly, you talked about balancing long and short ideas. What percentage of your portfolio do you look to be short?
Well, it's interesting. For the product that we're rolling out with Empire, we're going to primarily focus on long ideas. But I have a track record as a short seller. I was an active portfolio manager during the long-term capital crisis in 1998. I was an active portfolio manager during the meltdown in 2001, 2002. I was an active portfolio manager during the Lehman crisis, all these periods. I made money in every single one of those. So I think that there's a balance that if you take great long ideas, the 10 ideas that I'm talking about, and then you balance it with really well-researched short ideas, you can create exceptional returns, but also hedge your risk. So I don't know what percentages. I kind of let the market talk to me. I'm a big sports fan, and in baseball they say hit the ball where it's pitched, and that's kind of my strategy with the markets. So right now I'm not particularly short. I like things like I just pitched 3 shorts like Slack and all that. I think those are great opportunities regardless of the market environment. But I think it's an important thing to have, because we will go through cycles eventually, and it's a way for investors to differentiate themselves.
It's always about having a game plan for those cycles, right?
Yeah, exactly.
Thanks a lot for your time.
Cool. Thanks, Scott.
Certainly. Thanks for watching, and stay tuned for more updates.